Hello everyone, welcome back to another lesson. In today's lesson, you will look into a question which involves bank loan and interest expense adjustments. You will see the question on the left-hand side of your screen, and on the right-hand side, we have all the workings which I'll go through step by step. What I need you to do now is focus and follow through the entire content for an excellent understanding. So with that being said, let's begin. Anytime Jim took up a $150,000 loan from ABC Bank at an interest rate of 2% per annum on 1 May 2022, and the amount was deposited in the business's bank account. The loan is to be repaid equally over 5 years. So what we understand based on the first paragraph is that there is a business called Anytime Jim, which took a $150,000 loan from a bank, and this loan comes at a cost, which is the interest expense, applied at the interest rate of 2% per annum. The loan is repaid every 12 months, and it's paid equally over 5 years. The loan and interest expense are repayable every year on 30 April 2023, which is basically referring to the every 12 months, starting from 30 April 2023. The financial year of Anytime Jim ends on 31 December. All right, so the business has a financial year which ends on 31 December. So the requirement of the first part of the question is to prepare the journal entry that records the borrowing on 1 May 2022, and you do not need any narrations. So let's look into the right-hand side with all the workings. So we understand that we are working with a business where the financial year starts on 1 January and ends on 31 December. So we have to look into a time frame every time for our calculations in between 1 January and 31 December. Any transactions that have happened in between 1 January and 31 December, starting with 2022. So we will look into what happened in between 1 Jan 2022 and 31 December 2022. In this 12 months, the business took a bank loan of $150,000 on 1 May 2022, right? So what we have to do as the journal entry on 1 May 2022 to record this bank loan which we have taken is to debit the cash at bank account by $150,000 and to credit the bank loan account by $150,000. Why are we debiting the cash at bank account? Because when you are taking a bank loan, you are getting this funds or you're receiving this funds into your bank account. And your bank account is an asset account in itself. Because you're receiving the funds in your bank account is increasing in value, which means assets are increasing in value. When assets increase, we debit them. So that is why we are debiting the cash at bank account by $150,000. We are crediting the bank loan account by $150,000 because the bank loan account in itself is a non-current liability account. The reason we are saying it's a non-current liability account because this loan is repaid over 5 years, okay? And all liabilities when they increase are credited. So that's why we are crediting the bank loan account. So to answer our first part of the question, to record the borrowing on 1 May 2022, we have to debit the cash at bank account by $150,000, which basically reflects an increase in assets, and we credit the bank loan account by $150,000, which reflects an increase in liabilities. All right. Now, let's look into the second part of the question. Calculate the interest expense and interest expense payable for each of the 2 years ended 31 December 2022 and 2023. All right. So let's see what's going on. First of all, we want to calculate the interest expense in the year 2022. And in the year 2022, the loan was taken on 1 May 2022, right? So we can calculate the interest expense from 1st of May 2022 until end of 31 December 2022, which is the end of the financial year of this business, okay? So we are calculating the interest expense for the 8 months from May 2022 until December 2022. So how can we calculate it? We have the rate of 2%, which is an annualized rate, as the question clearly specifies, interest rate of 2% per annum, multiplied by the loan amount of $150,000, Then we multiply with 8 over 12, which basically adjusts this 2% annual rate into an 8-month rate. Because in the year 2022, the loan was taken on 1 May 2022. So it makes sense to calculate the interest expense for the 8 months starting 1 May 2022 and ending 31 December 2022. So this multiplication of 8 over 12 further adjusts the 2% annualized rate into an 8-month number. So altogether, the interest expense we have is $2,000 for the 8 months of 2022, starting 1 May and ending 31 December. Okay? Now, this $2,000 in interest expense is unpaid or accrued interest expense or interest expense payable at 31 December 2022. Why is that so? Because based on the question, we understand the loan and interest expense are repayable every year on 30 April 2023. We know the loan was taken on 1 May 2022, and the first repayment using cash or funds available in the bank account is going to be after 12 months from 1 May 2022, which means it's going to be at 30 April 2023. So at 31 December 2022, this $2,000 is still unpaid and accrued or interest expense payable, okay? So this $2,000 is clearly interest payable at 31 December 2022 because we haven't paid for this in cash, which means this is a current liability of the business at 31 December 2022. Now, let's look into the table which we were given for Part B. So we understand that based on our calculations in the year 2022, interest expense altogether was $2,000, which are for the 8 months of May, June, July, August, September, October, November, and December. The reason we are saying from 1 May 2022 is because that's the day the loan was taken. So it makes sense for us to calculate the interest expense for these 8 months starting 1 May 2022 and ending 31 December 2022. Next, the interest expense payable is also $2,000 because at 31 December 2022, we have this accrued amount of $2,000, which refers to the 8 months of May, June, July, August, September, October, November, and December. And the reason this is accurate is because the business pays for interest and loan every 12 months. And that first payment will be on 30 April 2023. So at 31 December 2022, this is still accurate or payable. Right? Okay, so let's move to the year 2023. Okay, so in the year 2023, which will start obviously on 1 Jan 2023 and end on 31 December 2023, we have multiple time frames that are involved. And we need to break these time frames and be careful with how we address this question. First of all, we want to look into the first 4 months starting 1 Jan 2023 and ending 30 April 2023. Why is that so? Because we are making a loan repayment and interest expense payment at 30 April 2023. Therefore, after 30 April 2023, the loan amount would change, which would definitely create some adjustments for your interest expense calculations. So to begin with, we will look into the first 4 months of Jan, February, March, and April. So in this first 4 months, let's calculate the interest expense that we have incurred, which is simply the annual rate of 2% multiplied by the loan amount of $150,000 multiplied with 4 over 12, which basically converts the 2% annual rate into a 4-month number. Altogether, the interest expense for the first 4 months is $1,000. Okay. Therefore, on 30 April 2023, we will be paying $2,000 from 2022, from the year 2022, which are the 8 months of May, June, July, August, September, October, November, and December, plus an additional $1,000, which are for the first 4 months of 2023. Altogether, at 30 April 2023, we will be paying $3,000, and this will be paid using our funds available in our cash at bank account. Okay? Now, at 30 April 2023, we also have a loan repayment. And based on the first paragraph of the question, we understand the loan is to be repaid equally over 5 years. The loan amount is originally $150,000. Paying equally over 5 years would mean that we pay $30,000 every year. So at 30 April 2023, the loan repayment is $30,000. So after the repayment is made, the loan amount that will be left is basically the difference between the initial amount of $150,000 and the $30,000 which we have just paid. Altogether, this leaves us with $120,000 as the remaining loan balance. Okay? Now, what's next? Now, we will calculate the interest expense for the remaining 8 months of the year, starting 1 May 2023 and ending 31 December 2023. And this interest expense will be calculated on the remaining loan amount of $120,000. So 2% annual rate multiplied by $120,000 remaining loan amount, and then multiplying it with 8 over 12, which are the 8 months from May and until end of 31 December. And altogether, we get $1,600 as the interest expense for the last 8 months in 2023. Okay? This means this $1,600, which are for the last 8 months of 2023, is an accrued interest expense or interest expense payable at the end of the year, because as you know, the next repayment after 30 April 2023 would be 30 April 2024. So this $600 is an accrued or interest expense payable at 31 December 2023. Okay, so let's just fill it in the table where we know the interest expense payable for 2023 is $1,600 at 31 December 2023. But what about the total for interest expense? Okay, interest expense basically refers to the 12 months of interest in the entire financial year of the business. And the business's financial year, as we understand and have clearly established at the beginning of today's lesson, is starting 1 Jan 2023 and ending 31 December 2023. For the first 4 months of January, February, March, and April, we have calculated an interest expense of $1,000, right? And for the last 8 months, starting 1 May 2023 and ending 31 December 2023, we have calculated an interest expense of $1,600. Altogether, the total interest expense in the financial year starting 1 Jan 2023 and ending 31 December 2023 is $2,600. And this is the amount for interest expense, which you will report in the statement of financial performance, also known as the income statement. Okay, $2,600. And if you were to prepare the balance sheet at 31 December 2023, the amount for current liabilities that you would include for accrued interest expense or interest expense payable would be $1,600. Okay, so in this table, let's fill it in, 2,600, which is basically 1,000 for the first 4 months plus 1,600 for the last 8 months. Okay, all right. So I believe that's good for you for today's lesson. Make sure to practice as many questions as possible. I have a playlist for similar questions, which you can see in my channel. I recommend you practice as much as possible because here we are acing our exams and our main goal is to get an A1 in our main exams at the end of the year. Also, you can check the link in the description where I have a link for you to book a free Zoom call and discuss your monthly tuition or coaching requirements for POA. And you must bring your parents so we can have a discussion and know where your weaknesses and strengths are and work accordingly and help you prepare and get an A in the exam. So with that being said, I will conclude today's lesson and I'll see you in the next one.